Perfect.
I didn't look to Arizona.
Let me bounce around a little bit. Hi, Gwen. How are you?
I am doing fine, thank you.
Great. Thanks for jumping on. Michael just stepped away, but I know Michael pretty well. Monique, how are you? We don't see you, and I think you're muted, but welcome. We'll have a few more people jump on, Juan, but it's at 6:06. I want to respect everyone's time. If you want to jump in, and I'll do a quick introduction, but
yeah,
we'll go from there. We'll take the small audience. Yeah. Let me switch over. So I'm gonna hand it over to Juan, guys. Juan is with the Quest Trust Company, and he is going to talk to us about investing with an IRA. So take it away, sir.
Yes, sir. Let me put this on big screen 1 second here. All right. Let me know if you guys see that. Should be just the intro. Awesome. All right, guys. Thank you for having me, first and foremost. My name is Juan Deshawn. So I work for Quest Trust Company. If you don't know who that is, we're one of the self-directed IRA custodians out of Texas. I'm currently in Houston right now, and we have offices in Dallas and in Austin, right? So what we deal with day in and day out are self-directed IRAs, and throughout the presentation, I'm going to explain to you kind of what that means and what is a self-directed IRA, kind of answer and tackle that question, and also what you can use it for, right? You can use it for a whole lot of things. Quest is very well-versed in the real estate realm. A lot of our clients do that kind of investment. So we're going to touch on those here in a second. So I'm just going to, all right, there we go. Disclaimer. So a little quick disclaimer is I'm not a financial advisor, right? What I'm giving you guys here is more information from a person who has really studied tax code specifically towards an IRA, right? Towards what you can and cannot do. But I'm not an expert I'm not a CPA, I'm not an attorney, I'm not an expert in real estate. By no means, I'm starting off myself in real estate, but I know how to apply the rules that I know with an IRA and apply the knowledge that you guys have with real estate and put those two together. And hopefully with my knowledge of the IRAs, you guys can use that to your advantage and towards your retirement building, right? Because the whole goal of this is to utilize retirement accounts and how you could continue to defer taxes, get tax-free profit. So we're really going to get into that in detail moving forward. And it's a very intimate class. I mean, if you guys have any questions, please, by all means, feel free, Mike, to interrupt me if you need to. If there's a quick question, we'll do Q&A at the end as well. But if there's a quick question, I don't mind answering it at all. I prefer something about the COVID times is doing Zoom presentations. We just do it in person. You don't get interaction. And so it's kind of like you're just talking to yourself for an hour. So I highly encourage just interaction. So please just answer questions. I can't see the chat box right now, but if you just interrupt me, that's totally fine.
I'll keep an eye on the chat box, man, and we'll just all be the guy to stop you if something happens.
So we're going to go ahead and start with what is a self-directed IRA. And primarily, the biggest thing that you want to notice is that there is no such thing as a self-directed IRA account. When you go to a Charles Schwab, a Fidelity, whomever it is, you're dealing with IRA accounts, right? And we understand what that is. We understand that you can invest that into the stocks, bonds, and mutual funds. We kind of have a kind of grasp of what that means. But then people want to move to what's called a quote unquote self-directed IRA. That's not a legal term. The only reason why there's a different term in front of the IRA word is just because it tells you that you can use it towards non-traditional assets. You can use it towards real estate. You can use it towards commercial property. You can use it towards promissory notes. And we'll go through those examples. All right. So that's kind of the biggest thing here is understand that the rules that I'm going to go through right now are applied to all IRAs anywhere, right? The only difference is what you can do with it. And so at Quest, we deal with the self-directed portion of it where you use it for non-traditional assets. All right. Some benefits and some things we're going to go over are diversification, right? Diversification is your funds right now, whether you have it in a 401k, whether you have it in an IRA somewhere, it's most likely going to be invested into the stock market if you have not dabbled with self-directed as of yet. And yeah, you can diversify. You can get some low risk mutual funds, high risk mutual funds, some CDs, whatever you got to do and diversify your portfolio that way. But is it true diversification? I'd argue it isn't, right? A lot of our clients have accounts with the traditional brokerage firms like Charles Schwab, Fidelity, and an account with us. You can have multiple because that is true diversification. At that point, you're diversifying your opportunity to invest into real estate, have some money here and invest into the stock market, right? This year was a huge example of that. When the market was doing horrible, right? People who had money in their IRA accounts that wasn't in the stock market, but it was invested into a promissory note. Like me personally, we weren't worrying about it. But individuals that had it in the market, they had lost all the return that they had realized until that moment. So that's why diversification is important. Think about that. Tax savings. We're going to go over the details of this, but ultimately all these IRA accounts have some sort of tax advantage, right? Some of them can give you deferrals. Oh, sorry about that, guys. Computer's freaking out. Some of them give you deferrals. Some of them give you tax-free growth, right? What is this? Ignore. Sorry. But we're going to see which account's going to be best for you based off of what you're looking for. Tax deductions, tax-free growth, tax deferral. There's going to be some sort of tax savings within IRA accounts, right? The other thing is social investing. This one is pretty interesting. The social investing really means is when you invest into real estate, you're impacting a community, you're impacting something other than just investing into a public company, right? So our president kind of puts it as when you invest into a property, if you buy a home or if you're loaning money out to a real estate investor, that real estate investor is out there outsourcing that to local contractors, putting money in local contractors' pockets, building a home, putting a family in that home, and that family white picket fence around that house. So your money has a social aspect to it. And I think real estate in general is just a social kind of investment, right? You got to talk to people, you got to network, you have to be part of these Zoom calls, right? And then the last thing is invest in what you know best. That one is huge. It's just, if you are an expert in the stock market, absolutely go crazy with the stock market. But if you're an expert in the real estate, that's the same way you put food on your table. Why wouldn't you apply those same strategies to your investing through your retirement accounts? Most Americans have their money in these retirement accounts. Why wouldn't they apply the strategies they're familiar with to grow that even larger, right? They probably can get a better return if they're applying what they already know, as opposed to just hoping that the market does well. Most people don't know how the stock market works, all right? So that's a little thing up to what the benefits of this self-directed IRA is and why you'd want to maybe go this route. So kind of the bulk of it, and this is where maybe questions will come up, please ask them. But we're going to go over the 7 types of plans that Quest administrates and kind of the most 7 common plans that you would see at any custodian anywhere you go. We group them into 3 different categories, one being the personal plan, then the employers, and the specialty plans. So let's go in order. The personal plans are accounts that anyone is eligible to have, right? You're going to see terms like Roth IRA. Everyone talks about those. I'm going to touch on that in a second. But these plans are eligible for you as long as you have earned income, meaning you make some kind of salary, you make some kind of income on an annual basis, and you can continue to contribute to the plan, right? You can put money into the plan. These accounts, you may have one or the other. You may have one right now. These basically anyone with earned income can start one. You can have 5-year-olds with a Roth IRA, for example, right? The difference between the two is a traditional IRA is typically pre-tax money. So money in there you have not paid taxes. A Roth IRA money is after-tax money you have paid taxes on. The growth of these 2 accounts, the traditional IRA, because you haven't paid taxes on that money yet, it's called deferrals, tax deferrals, right? Meaning you're putting off the taxes and putting it off and putting it off and putting it off. Similar to your 401k accounts, right? Your 401k accounts, the whole goal is you're putting money in it, and eventually when you retire at a certain age, you take the money out, and that's when you pay taxes. Ideally, ideal situation is you're at a lower tax rate in the future than you are now. A Roth IRA is quite the opposite. It's after-tax money, so you've already been paid taxes on the money. It's gone to your checking account, it's gone to your savings account, but you put some money in the Roth now. And as you grow that, the deal with the IRS is if you leave those earnings, the growth that you got in the Roth IRA until your age of retirement, which is 59 and a half, according to the IRS, you can distribute or withdraw all the money that you've made in there completely tax-free. So the opposite is instead of deferring and paying taxes at the end, you pay taxes at the beginning and do not pay taxes on the end, right? If it's kind of a simple situation where you have $1 and you can pay taxes on the dollar, but you're going to grow it to $1 million, it'll be obvious what you want to do in that situation, right? You want to do that in a Roth, right? But most individuals, that's not the scenario. Most people's money, especially in retirement accounts, come from pre-tax bucket of money, like a 401k, TSB, 403b. You're working for someone and they're providing you with an employment plan. And typically the money that's put in there is pre-tax because the employer is receiving a deduction on it. And you are probably putting in it before you pay taxes. So most of America's wealth is actually in these pre-tax buckets of money. That's why most people even at Quest or anywhere, will have a traditional IRA. That's why maybe someone on this call probably has a traditional IRA or a pre-tax type of account. And that's what you would probably be working with. However, if you're one of those individuals, that's okay. You can still have a Roth. You can either start one and put some after-tax dollars in it and continue to invest with that, or you can do what's called a conversion. A conversion is when you take money from that pre-tax account, the traditional, and convert it to the Roth IRA. What you're deciding to do, and let's put numbers in place. If I have $10,000 in my traditional IRA, and my goal, let's say I have an awesome, sweet deal coming up, my goal is to grow that to $50,000, let's just say in one day. I would rather pay taxes on 10,000 than 50. So what I can do is I can convert that $10,000, that 10 grand adds to my income for the year that I do the conversion. Say I did in 2020. I would personally pay taxes. I'd be liable for taxes on $10,000 extra already on top of what I make that year. However, now I've just invested and then I grew it to 50,000 because that was part of the deal. Well, then now I have tax-free profit, right? And I won't ever have to pay money on that ever again. Eventually, when I'm older, when I'm 59 and a half, 60 years old, the idea is, well, now I have a big bucket of money that I don't pay taxes on ever again. I just bit the bullet on the front end. So you are able to do that. If you're an individual that has that situation or thinking about it, it is an opportunity. You want to look at things like, how much you're making this year? How much will you make next year? Is it a good time to do it now? Especially this year, COVID year, we had a lot of people do conversions just because people were unemployed or were laid off. They made a lot less money than they did last year, and they're going to be employed again next year. They're going to make more money next year. So they said, I'm going to bite the bullet now. All right. So there's different things you got to think about, but the idea is that you can have both traditional and Roth IRA.
Hey, Juan.
Yeah.
Question on that, and I know you're not a CPA and you don't give tax advice. So if I had a traditional IRA, it's pre-tax to your point, I want to convert it, right? So those dollars get all, so let's say it's $10,000, like you said, that gets applied against my earned income, right? So I'm going to pay taxes on whatever that changes it to. So if it moves up in tax bracket, I pay the new tax bracket. Is there an additional penalty to convert that to a Roth, or is it just the tax?
Good question. Yes, so no penalty, just a tax. And I could say that with 100%, like that, no penalty at all to do conversions. The penalty that you guys are thinking of, I'm not sure who asked the question, but the penalty would be when your withdrawals, right? If you're before the age of 59 and a half and you take the money out personally, so you go buy a car to do whatever you want, that's when they penalize you 10%. But the conversion, that's a thing where you're keeping it within the vehicles, you're keeping it within these bucket of monies, and you're moving from one bucket to another. So no, you're just paying taxes on it. As you mentioned, on your income, may or may not bump you up a tax rate. Just depends on where you're at. All right.
Thank you.
Good question. And I'm going to go over as well on the next slide. It comes up contribution limits and such. So we'll touch on that in a second. I just want to kind of explain the accounts conceptually for now.
Sure.
The employer plans, these are super cool. So these are helpful for individuals who have self-employment income, right? The benefit of them is the IRS basically created them because there's people who have their corporate jobs and they get a 401k and people who don't. So there's got to be some kind of incentive for you to put some money away toward retirement because you have self-employment income, because you're a self-employed entrepreneur. SEP, simple, and solo 401ks. There's 3 different types of plans here. A SEP IRA plan is probably the most common one we see. A lot of realtors use this. Basically what it is it's very similar to a traditional IRA. It's a pre-tax account that grows tax deferred. What happens is the employer, remember you're a self-employed individual, which is you basically, can put a certain amount of dollars in a SEP plan based off of how much you earn. Now, when you're self-employed, you can be a W-2 employee of your own business. You can be a 1099 contractor. You can file on a Schedule C, right? So basically, the rule of thumb is you can put up to about 25% of what you make in a SEP plan, not to exceed 57,000, which is still a whole lot. You make 100 grand a year, you're paying yourself 100,000. That's $25,000 that you could potentially put in the SEP plan, and your business could take a deduction. So super cool there. Very common. A simple IRA is for practices. We see this a lot with like dental practices. People with 100 or less employees, usually a lot less. But what happens is it's kind of like a matching incentives plan, a mini 401k, I like to call it. What happens is you, as the employee, can put a certain dollar amount in there, 13,500, for example. And the employer can match between anywhere from 2 to 3%. That's really it. Very simple plan that you just match your employees what they contribute to it. And again, it's also pre-tax money. Comes out of your paychecks, and then also the employer puts the money in, pre-tax bucket of money, right? Now, solo 401k, I'm going to touch on this during this presentation a lot more, because a solo 401k, the question comes up a lot if you're eligible, if you should look into one. A lot of people are talking about them now more than ever. So I have actually slides dedicated to a solo 401k that we'll touch on later. But understand that for now, it's basically a very large self-employment plan. It's like that corporate 401k plan that you can have, but just for you and you only. So we'll touch on that in a few slides, and I'll get to that after. Specialty plans are the only plans that you can actually take advantage of today and now. There's two ways to do it. We have the HSA and the Covered Education Savings Account. The HSA is a fantastic plan, probably one of my favorites because I have the HSA and I have a Roth. But my HSA I use probably a lot more. The glasses I'm wearing right now, I bought them with an HSA account. What this is it is a retirement account, right? It coincides with your health insurance. If you have a high deductible health plan, you may be HSA compatible. I have no dependents, so I can put up to $3,550 every year into my HSA plan and take a deduction on that. It lowers my taxable income. If I have a family, if I had dependents, well, I can double that, and I can still use it also for deduction. I can invest it. I can do everything I can with any of these other accounts. However, I can take money out before retirement age for the purpose of health expenses, specifically qualified health expenses. There's a whole list. However, it's a whole bunch of things. You can go to a chiropractor. I've done it before. You can go buy over-the-counter medicine. You can pay for the dentist. Also did that. Eye doctor, did that. Buy my glasses. You can do a whole lot of things. As long as it's qualified medical expenses, you're okay. Can't use it for like cosmetic surgery, like you don't like your nose, you want to buy yourself a new nose. Can't do that for that, unfortunately, right? But you can use it for any medical expense. So it's really cool, and the money comes back out tax-free. So the idea behind it is, if I put money in $3,000, I turn it to $6,000, and I have a medical expense for $6,000. Well, I can turn around and take that all back out tax-free, not paying any income on what I made, $3,000, right? The cool thing also is, what a lot of people do, especially with self-directed HSAs, is usually they invest that monies and it's not going to be available to them when maybe the medical expense comes around. So what do you do in that situation? Keep the receipt, because when that cash comes back, you can actually reimburse yourself for any medical expense completely tax-free that occurred within the time that you established that HSA. So if I established HSA today and I had a surgery tomorrow, God forbid, of $10,000, and I don't have that in my HSA, 10 years down the line I do, I can reimburse myself for that expense. Even though I already paid it, it comes out tax-free because technically it's a reimbursement for that medical expense. So I think that's super powerful. Our president did that. He had a massive medical bill one time, and it was amounted to about $30,000, hospital bills and all. Obviously, he ended up paying for it, but not out of his HSA. As he invested it, eventually he had that in his HSA, took a $30,000 distribution, and bought whatever he wanted with it. Technically, it was a reimbursement for the medical expense. So it's super powerful if you know how to use it correctly. If you set one up and you have a high deductible and then years down the line you no longer have one, it doesn't go away. You just can no longer add funds to it. You can continue to invest it, however. The money doesn't go away at the end of the year. So you might hear that term of FSA, the flex savings, I think, account. It's not that. The money continues to roll over, so you don't have to use the money, right? Which I think is cool. So it's a very powerful plan. And I think we call it the best of both worlds: tax deduction, tax-free. The Covered Education Savings Account, kind of similar idea, but it's for education expenses for children under the age of 18, ideally. So what you do is you can start it for a child under the age of 18, put money into it every single year, very small amount, $2,000 a year per child. However, you continue to invest it. You can invest it like any of the other accounts as well. You can take the money out tax-free for educational expenses. Same thing you could do for the HSA. That can pay for books, uniform, tuition, college expenses, right? Backpacks, laptops, right? Whatever it needs to do for the educational expense, it can pay for that. Again, the idea behind it is invest that money, grow it, and the earnings you make, take it out tax-free to pay for those educational expenses that you will have, right? Especially if you have children or grandchildren, right? The thing is, after you turn age 18, you can no longer contribute. that contribution limit is $2,000. So ideally you want to start when the child's young, right? To kind of accumulate that and continue to invest it. Compound interest will work its magic. And then once they turn 18, it doesn't go away. Continue to invest it. However, you just can't add more funds to it. Once they turn the age 30, this is where they can decide, okay, do I want to distribute this, take a full withdrawal and just take it as income? Or do I want to pass it down? They can actually pass it down to maybe a child of theirs or a cousin, someone younger as well. So it can continue to be used. So pretty interesting there. It is an account that's very popular, but I would say it also takes a little bit more of creativeness to use, because when you're started off, you only have $2,000. So what we see often is you may use a ESA, you may use a Roth, you may use your HSA, all to fund one deal, and each account will get a piece of the pie. And I'll explain that moving forward. I actually have a case study that 9 different IRAs were involved in one deal. It was some Roth IRAs, it was some HSAs, and it had 2 ESAs. I think the kid was like 4 and the other one was like 12, right? They didn't know, but their parents are doing it for them, right? So it's kind of cool. Any questions on that? We're about to go into contributions and stuff. So
You said you're going to go over a case study on that example.
yeah, we'll go over that stuff too.
Perfect. Awesome.
All these accounts, they can get funded one of 3 ways. So we have transfers, rollovers, and contributions. On some of the accounts, I went over the contributions, but the transfers and rollovers, what that means and the difference between the two is basically a transfer is IRA to IRA, so like accounts. So if you're an individual who has an account, let's say at Merrill Lynch or Fidelity, and it's a traditional IRA or sometimes referred to as just an IRA, that can transfer directly to the same type of account, an IRA, a traditional IRA, right? The idea behind it is you're keeping the money in the same plan and just moving it from one institution to another. This is the transfer. Non-reportable, doesn't report anything to the IRS. It's just only you know it's happening, and it's just moving money from one place to another, right? You can do it as many times as you want a year, back and forth. That's how people have multiple accounts. That's how people diversify, because they may have an account at Fidelity, they may have an account here at Quest, and they'll transfer money back and forth. Pretty simple there. A rollover is when you have employer plans, like a 401k, 403b, those 3-letter abbreviation terms. You move those into an IRA. That's a rollover, because what you're doing is you're basically leaving one plan, which is completely different from an IRA, and you're putting it into a new plan. You won't be taxed, because what we do is we would move you from, if your 401k is pre-tax, we'll put you in a pre-tax IRA. If it's post-tax, we'll put you in a post-tax IRA. So ideally that movement's not going to cost taxation. It's just moving the actual structure of, I guess, the bucket of money, put it that way. That's just the fancy term of rollover. And contributions are what you can personally put in a year per IRA account, per person, I guess. If you have a Roth IRA, for example, that contribution limit is $6,000 if you're under the age of 50 and $7,000 if you're above the age of 50. Traditional IRA is the exact same, $6,000 under the age of 50, $7,000 above the age of 50. These are the personal plans. I'll go see if I can go back here. Yeah. So these accounts, they're cumulative. So say I'm an individual with a Roth and a traditional IRA, by the way, I can only contribute $6,000 to either one of them, or I can split it, $3,000 each, or whatever kind of ratio you want to put it. But I can't put 6 in each, right? They're kind of considered one group. The employer plans are considered separate, so that's okay. And so are the specialty plans. These are the only ones that are kind of considered the same, but they work different. It's interesting, right? So that's the 3 ways that you can put money into the accounts.
Question, Juan.
Yeah.
It's question for you. Now, when you transfer from, say, for example, from Fidelity to your company, is there some kind of limitation on how much we can transfer, or is that up to us?
Great question. So it's going to be up to you. Okay. So transfers and rollovers are not capped. The only thing that is capped annually are contributions. So you can move over whatever you have available, half of it, 25% of it, whatever you need. Okay. At times, with self-directed IRAs, the money sitting in there does not make any money unless it's invested. Right. Sure. So usually you move over what you need, right? You may move over, let's say you invest in 50 grand, you move over $50,000, maybe $51,000 to cover transactional costs and fees of the custodian. But usually you move over what you need, because otherwise your money's sitting there in cash doing nothing. Yeah.
Another question. Another question for you. From your standpoint, do you see a lot of people that invest their money into their IRA account into real estate? Do you see a lot of that's happening?
Absolutely. So, and
Okay.
actually, this is a kind of soon in our slides that kind of leads me to that, but you'll see that Quest, although we deal with self-directed IRAs, and you can invest into almost anything that's you can take title to with your account, and it's private. A lot of real estate investors, right? Quest has kind of created the company to facilitate real estate transactions because that's kind of mostly what we see. But we see it in two different ways: passively or kind of actively. A passive investment would be kind of like commercial property, right? Here's my capital, I'm giving it to you to invest my capital and give me some kind of return after a few years, right? That's a passive investment. Or here's my money, I'm going to loan you this money, you're going to pay me interest. That's a passive investment. Very common. Probably most of what we see is that approach. The other approach would be actually taking title to property. I'm going to use my IRA account, buy a piece of the house. The IRA owns this house. Tenants live in it, normal situation, but they're paying rent not to you, but to the IRA. That's a more active approach, which happens probably less, but still a good amount of people, right? So yeah, great question. We definitely see all the time. And I think our company wouldn't be here if it wasn't for real estate investors and using IRA. That's kind of mostly what we do. So absolutely, yeah.
I'm sorry, I have another question for you.
Go ahead.
Now, would you say that I'm familiar with traditional IRA and Roth IRA account. This is very attractive, especially when you have a lot of money in the Roth IRA account. This is very attractive way to invest real estate.
Yep.
I didn't know that you could use Roth IRA. I thought you could just use the traditional IRA.
Yeah.
So now this becomes more attractive to me now. So, okay, that's good. Good information. Thank you.
We're not done yet.
Okay.
Beginning. Yeah, no, definitely very attractive, especially as you mentioned, Roth IRA, because think about it. If you're an individual, the retirement age is 59 and a half. Let's say you're close to it, or you're even past it. If you're an individual doing transactions with the Roth IRA, you can essentially have tax-free income, right?
Yeah.
You can funnel it through it. Of course, you need the capital for it and all, but that's the idea behind it. That's kind of the goal that we want to get you to.
Especially when you're a young person,
Exactly.
it's the way to go.
Exactly. So
Yeah.
for a lot of young individuals, I mean, myself included, I'm 25 years old. Myself included, I started my Roth IRA about 2 years ago. The whole idea behind it is making contributions, right? Put in $6,000 in, if you can, of course, or you can put it in. But with a self-directed IRA, you got to find those opportunities. But let's say I do private lending. An example of mine will come up soon. And I want to receive about 12% interest, right? If I continue to do that and continue to contribute, compound interest will work its magic, right? And then eventually when I become 60 years old, that should be a massive account. That's the idea behind it. So absolutely, when you're younger, you have the time to do it and the money to put away. So it's definitely something to consider. And that kind of brings me to my next point here. I mean, when you are young, or when maybe you don't have, 100 grand in a Roth IRA or 100 grand traditional IRA, you may be eligible to have multiple accounts. These all accounts can be partnered together, right? This page right here is an example of what it looks like when multiple IRAs take ownership of one investment, whether it be a passive investment like we spoke about, or whether it be taking title to real estate. An individual vesting, which means the actual name of the individual IRA account, is Quest Trust Company, FBO, John Smith, IRA 1, 2, 3, 4, 5, right? But when you use multiple accounts, what happens is there's an undivided interest between those accounts. In this scenario, it's 50-50. So you can see that you can use multiple accounts. These can be multiple accounts of different people, me, my friends, or this can be me, my Roth, my HSA, and my child's ESA, or my Roth, my HSA, my wife's Roth, my wife's HSA, whatever it is, right? You can use multiple accounts, and each one of them will get a piece of the pie. And an example of that will come up soon. So you can think about that. Hey, I have an HSA plan, I have a Roth IRA, and I have a traditional IRA. That's 3 buckets of money I can use to fund larger projects, right? That works 100% with passive deals, right? With passive investments, it's a lot easier to do that because to the borrower, to the person you're sending the money to them, it looks like it's all, they might get a $50,000 check, but it came from different people, right? So very, very easy to do.
Okay.
Now, we're going to talk about what you cannot do, though. Right? This is kind of where things can get dangerous. So there's disqualified persons to your IRA, people who cannot benefit from your IRA directly or indirectly. And it's pretty simple. We're going to talk about the first person is you, right? So what this shows here is that you are on the other side of the fence, that little line right there. You cannot enter into transactions with your IRA account, right? That's a no-no, right? You cannot benefit from it. The whole idea behind IRAs is when you reach that retirement age, that's when you benefit from it. That's when you take the money out, and that's when you potentially pay taxes, right? The whole idea behind this is the IRS wants to get you to pay taxes, right? Uncle Sam does not play around, right? But there's other people too. There's this fancy graph right here, right? You can memorize it, and you want to live by this. But this is what you cannot do. And I'm going to real simplify it for you right now, so don't worry about it too much. But basically, you, as we mentioned, you are disqualified to your IRA. So is your spouse, so is your children, so are your children's spouses, and so are your parents. All right, those are the people, as well as the companies that those individuals own, manage, or maybe highly compensated by. That's a way that you could think about, okay, can I do a transaction with this person? This doesn't mean can I partner with this person? Like in this example back here, this doesn't mean that I can't do this with me and my wife because she's a disqualified person. No, I can't. That's okay, because we're on the same side of the fence. But I can't go ahead and loan my wife money, and she can't loan me money, because then I'm receiving a benefit from her IRA, and she's receiving a benefit from me, and we're disqualified persons to each other, because the only way that they want to do that is distribution. And they disqualify those people because typically wealth is passed in that direction. When you pass away, you usually give it to your wife, usually give it to your kids, usually give it to your, those individuals. So that's the fancy kind of ugly list of what you cannot do with those people. You cannot buy, sell, loan, trade, or extend a service. You can't buy something from that person with your IRA. You can't sell something from your IRA to that person. You can't loan them money. You can't buy a home and let your son live inside of it even, right? That's not the purpose of this. That's not an investment property anymore, right? You couldn't live in a property that you own. That happens all the time. People buying beachfront property within the IRA accounts and want to go ahead and live inside of it. Unfortunately, if you want to live in that house, you would have to own it yourself personally by taking it out and distributing, right? So you gotta be careful with that. And that's kind of the whole purpose of why there's companies and custodians will make sure you're not doing this blatantly prohibited transactions. But just keep in mind, there are some things that you cannot do. But besides that, if you're not dealing with these people directly, if you're doing a transaction with someone that's not one of those individuals, you're usually in the clear. Investment wise, what actual investments are not allowed? There's only two of them, right? At Quest will only facilitate private investments, but that doesn't mean you can't do stocks. That's just with another company. But what you actually cannot do are life insurance contracts and collectibles. Life insurance contracts, they just don't want you betting on someone dying. A lot of people will drop dead a lot faster. And collectibles, there's just no intrinsic value for it, right? There's no, piece of art, for example. The IRS always needs to know how much is in your IRA, how much it's worth, how much the asset's worth, because that's how they know how much they can tax you. But a collectible, I don't know what it is, right? A piece of art that may be $1 million to someone might be $25 for me, right? I'm not into art. So it may not be the same. So there's no value to it. So they say, what, collectibles, you can't do it. Right? So those two things, you cannot invest with an IRA account. That's really it. Besides that, sky's the limit. You have real estate, right? You have private entities, and you have promissory notes. This is the same way that we also split up Quest Trust Company in 3 departments to help you with their transactions. Real estate, those are when you're actually taking title to real estate. Private entities, if you're interested in commercial property, investing into apartment complexes and such, this is where you would be in, because typically you work through a limited liability corporation, an LLC, right? You're usually working through where you're giving your money to an LLC. That LLC is going ahead and working on the project, right? Limited partnerships, joint ventures, and trust as well. There are ways to get your money and capital working in very creative ways where someone else kind of does all the work, where they're kind of just using your capital as an investor and you receive pretty good profit. And then promissory notes is where you act as a bank. You are loaning money to an individual, right? I have an example of a loan, right? I give you this money, I pay me X amount of interest, I have a first lien position on your property, right? You act as a bank. So those are the kind of 3 different things we see with the accounts. So I'm about to get into a solo 401k. I told you guys that the solo 401k is very popular. There's reasons why it's popular. And the thing is that I wanted to touch on it because I think a lot of people are talking about it right now, and you may have questions about it. You may be one of those people that are talking about it. A solo 401k is for self-employed individuals. For people who have no employees and have some sort of self-employment income, doesn't have to be a certain amount, but want to provide themselves with a pretty flexible and account that gives them a lot of power. And it comes in handy as well when doing doing real estate investments, whether it be passively, whether it be through an LLC, or whether it be buying real estate debt leveraged. Right? There's a lot of advantages to it, and we're going to go through those advantages briefly, so you guys understand and see if this is an option for you. So again, who should have it? Self-employed, company owners, got to receive some sort of self-employment income, individuals with no common non-employees, so you can contract and hire people. In short, just be self-employed, right? So the biggest advantage, or one of the big advantages, I'm gonna move this little thing here, it's blocking half my screen, is checkbook control. Checkbook control means that you actually are the ones writing the checks. In all of the IRA accounts that we have discussed thus far, you work through a custodian. You work through someone like Quest Trust Company to make your transactions possible. You tell us, hey, I want to make this investment. You work through one of our departments. They're the ones moving the money from point A to point B. We're not giving it to you to send it to someone else. We're moving it directly to them and receiving the funds and handling the bookkeeping, handling the administration. A 401k just gives you complete checkbook control. You have access to it. You're the one writing those checks. You are the one that says, you want a $50,000 investment for my 401k? There you go. All right. You are that person. That's a huge advantage. You don't have to go through a custodian anymore. So if you're looking for that, this may be a plan for you. But also has some dangers, right? You have control of the checkbook. That's a danger in itself. Like Spider-Man, great power comes great responsibility, right? You got to be careful because you're still under the same rules of what you cannot do. So you can't just be going out writing checks out of your 401k because that's where your money is, right? If you have 100 grand in your 401k right now, and you're like, I'll get the solo so I can have a checkbook and buy myself a nice car. No, right? You still want to utilize it the same way your employer would if you worked at a corporate job, right? For investment purpose, for your retirement purpose, and for, for real estate purposing. So advantage 2 is large contributions. We touched on like a traditional Roth IRA, limit to $6,000 or $7,000 a year on what you can put in personally. The 401k gives you an advantage to put a lot of money in. Personally, you can put up to $19,500, possibly an additional $6,000. So almost $25,000 just from you personally. And then from another side, your employer can put even more money in. We touched on that step earlier that you can put about 25% of what your employer pays you or your self-employment income. Well, you can do that same thing in the 401k. So it kind of combines those two. So you can put potentially, if you're 50 or over, $25,000 basically as an employee, and maybe a lot more from the employer side. That amount can be up to $57,000 or $63,000 if you're over the age of 50. So you can put a lot of money in there just by contributions, taking deductions, etc. And it's very advantageous over the other accounts that have smaller limits, right? So that's a huge advantage in itself, just large contributions.
Hey, Juan.
Mm-hmm.
So yeah, I think this is perfect. This is exactly what we're going to get to. So again, I'm a sole proprietor, business owner, but I am a W-2 employee. That's the key designation, right? Because then I have an employer responsibility and then I have a employee responsibility to contribute.
You got it. Yeah, exactly. So with a 401k plan, you're kind of acting as two different people. You're the same person, but you're acting as two. You're the employer and you're the employee. So as you can see here, this chart kind of makes it easier to understand. The employee has a salary deferral and can even be after tax, whether it's 19.5 or 6,000 plus if you're over the age of 50. And so does the employer. And that depends on basically your earnings, right? And there's a combined total cap and everything. So this is a really good graph to understand kind of basically what the contribution limits are. So as you can see, a lot of money.
And there's no, like on a Roth IRA, there's no income limitations?
Good question. Yeah, no income limitations on your contributions to a 401k, as well as you can see here, you can do after tax contributions to a solo 401k, no income limits as well. I didn't touch on that. So for anyone that doesn't know what that is, in a Roth IRA, if you make too much money, if your modified adjusted gross income is above a certain amount, you may not be eligible to contribute directly to a Roth account, but you could contribute to a traditional and you can convert. There's no income limit on conversions. There's still a way around it to acquire a Roth IRA. You just got to work a little bit double, right? Yeah, great question. The other one is loans to yourself. So like a 401k at a corporate job, you can loan money to yourself. All right. So if you're in a bind, you need some money, you can actually loan $50,000 or 50% of your 401k account, whatever's less. In this year, because of COVID and the CARES Act, it raised it to $100,000. Regardless of the balance, you can do a loan. But essentially what happens is you have to pay that back with interest within 5 years. It doesn't hurt too much because you're paying yourself back, but it is something that you pay back. So it's not a distribution. You don't pay taxes on it because it's a loan, but you would end up paying it back. The rates as to what you pay it back are usually prime rate plus 1 or 2 points, what you would want to put there. Right? You decide ultimately what the points would be, but that's kind of a good base to go off of. So that's a big advantage because on IRA accounts, I get the question a lot is, hey, can I use that money to give it to myself? I'll put it back eventually. No. 401k, you can though. And then this next one that might get a little complicated, but I think it's the biggest advantage is the exemption to UDFI, or sometimes referred to as unrelated debt financed income. Or you might hear someone say, hey, are you incurring UBIT? And we'll touch on the differences of those two. But the 401k has an exemption to this, to UDFI, which basically happens when you take on debt leveraged real estate. This happens when an IRA or 401k takes out a loan, or when you invest into what's called a pass-through entity, like an LLC, and then that LLC takes out a loan. You would still incur this taxation. So I think this page is better. So UBIT. UBIT is the actual tax, or UBTI, whichever one. And it's associated with an IRA running an active business, receiving a loan, or buying real estate buying property not attached to real estate, like a mobile home. Unrelated debt financed income is like a subsection of it. The way I kind of explain it, I like cars, is I explain the UBIT as a Volkswagen, and UDFI is like the Jetta. It's one of the types of Volkswagens you can get, right? So it's like a subsection of it. And the 401k has an exemption to this little subsection of this tax. Now, why would you want to avoid this? Why is this a bad thing? Well, first thing is you're kind of probably using the retirement account to not pay taxes, so you want to try to avoid that. Second is it actually gets taxed at a pretty high tax rate. On this top right corner here, you can see what I'm talking about. Now, I'll explain this in a little scenario in a second, but basically look at these numbers. If you make $13,000 in profit, you could potentially be taxed 37%. Right? It's pretty high. But the way this works is, I'll give an example. If I buy a home, if I want to buy a home for $100,000, let's say, but I only have $60,000 in my IRA account, and I go out and get a loan for the $40,000 that I need. Let's say I'm going to buy and sell in a day and just double my money. I am, in this scenario, 40% debt leverage. I borrowed 40% to buy the property. I turned around and doubled it. 60% of my profit would go back into my account free and clear, right? Because I used IRA money. That money should not be taxed. But the IRS says I went outside of my IRA money and I received a loan for $40,000 for 40%. So that means that 40% of my profit was made using non-IRA money. So the IRS, of course, found a way that, hey, we can tax you on that money, right? So you look at how much you made in that percentage, and that's what you end up paying taxes on out of the IRA account. Not you, the IRA pays taxes. So this happens to IRA accounts, and this happens a lot with highly debt leveraged investments like commercial property, right? When you're investing into an LLC, they're usually getting the money to go towards a down payment on a larger project, but they're going to finance. And so your profits, whenever they sell or whatever happens, will probably be heavily debt leveraged. So you may end up paying this UDFI tax. Now, again, this is something that if you do get involved in, I have some referrals for CPAs that definitely assist, and you want to look into it. It's nothing to be scared of. It's just to be aware of the situation. And it kind of also explains why the solo 401k is so sought out. It just waives that. Even in my scenario where I doubled my investment and I used 40% debt, I do not have to pay taxes in a 401k, but I would in an IRA. All right. Then you still incur this tax in a 401k if you run a business. So the way they think about it that way is if you have a lemonade stand and if you're running a lemonade stand next to another lemonade stand, but yours is under a 401k account, it'd be unfair if you didn't pay taxes because your prices would probably be unbeatable. So what they say is if you're running a business, they're going to tax you like a business, and they're going to put you on this tax rate right here. So don't be running businesses in 401ks or in IRAs in general because you're going to be taxed like one. But debt leveraging is definitely a strategy that's used commonly. It should be used. It's very smart to use it, but just be aware that there may be taxes. In a 401k, you can avoid it. Other ways to avoid it if you're not eligible for a 401k is your investments is loan money. When you're loaning money, you don't have to worry about that. You're just loaning the money. And the other way is investing into taxable entities like C corporations. C corporations, we call it the C blocker. A C corporation pays taxes at the corporate level. So before it passes taxes down to the shareholders, it's already paid taxes. So the IRA wouldn't have to.
Hey, Juan?
I hope that made sense. Yes.
So an example, right? I'm a passive investor. I'm going to invest in a real estate syndication. I'm going to use 50,000 and put it into an apartment building, for example.
Yeah.
My 50,000 is let's just say it's 10% of the raise, the equity raise, and that equity raise is only 30%. We're going to borrow the 70%.
Right.
And then it's a 5, 6, 7, 8 year hold. My 50K, when we do sell, right, the investment offering says it's going to turn into 100K, right?
Okay.
So I'll double my money in 7 years. At some point, UBIT could kick in, right? Obviously, I'm going to have other tax shelters based on depreciation and all that, but there will be, when we do sell, that taxable event does kick in. And so there's an opportunity for tax in addition to your traditional, capital gains, right? That's what this describes?
Exactly. Right. So throughout the years leading up to the sale, you don't necessarily usually pay taxes because you're not really showing a profit.
Correct. Exactly.
Later on, once you finally do, that's when you show your profit. And so the money that you do realize and then end up gaining, a certain percentage of that, depending on what in year 5, 7, or 8, how much debt leverage that project was in that entire 12-month span, that's how much you may have to file on what's called a Form 990T. You actually report that my IRA made this much money. And using depreciation and expenses throughout that entire year, you can lower that. And you may end up paying taxes on, let's say, if you doubled your money, let's say you ended up paying tax on $10,000, but you made 50 grand. That $10,000 will be taxed on a bracket system. Sure, it might get 35%, but you still made $40,000 without paying taxes, right? So it's still something to highly consider. It's just leveraging the fact that it's leveraging loans. It's okay. It's the way real estate works. So it's just something to be aware of, absolutely. And yeah, that form that you filed this tax, by the way, is 990T. So that's kind of like the IRS tax form or IRA tax form.
I'm Mercedes again. So
Yeah.
another question is, so what happens when you're using the Roth IRA account, which is when you sell the property, everything should be tax-free.
Great question.
Right?
Great question.
So it's kind of like, should you use a traditional IRA or should you use the Roth IRA? If
Yeah.
you kind of look at it on the long term, I think you're much better off to use Roth IRA account because you won't be taxed anymore. Am I right?
Well, you're right, sort of, right? So
Kind of? Okay.
because in this, even a Roth IRA can pay taxes. So remember,
But still.
you're not paying taxes. You personally are not paying taxes. It's the IRA paying taxes. So no matter what account you use, it can still incur this UDFI tax.
Oh, I see.
However,
I'm,
right?
okay. I'm still on. Okay.
Is if I incur the UDFI tax in a traditional IRA, my IRA pay taxes, and then later down the road, I'm going to pay taxes because all I'm doing is deferring the other percentage of it, right? The profit I made. But in a Roth IRA, in that scenario we talked about where I paid $10,000 or $10,000 was subject to taxation on my $50,000 gain. If I did that in a Roth IRA, well, at least I made 40 grand tax free, right?
That's that. Yes.
It's
Yes.
still huge. Exactly. So absolutely, definitely always better if you can do it in a Roth IRA, but it's not exempt from the taxes. The only account that's exempt is the 401k, which is what else?
Oh, I see. Oh, it's okay. Got it. Okay. Boy, there's so many loopholes.
Right.
Okay, got it. Okay.
No worries. There are responsibilities to this account, and I'll fly through them, but it's legitimizing, which means is Within the first 3 years of the account, you want to legitimize it, which just means that you want to make sure you're eligible to contribute. So if you set one up and you end up finding out that you're not eligible to contribute or to have one, you got to close it out. You don't want to just have it outstanding there. You want to be able to contribute to it within those first 3 years to show that, hey, I have self-employment income. I'm doing things correct. I'm using for the plan for what it's for. Prohibited transactions, that big graph we talked about, it still apply. You want to make sure you still understand it so you're not doing anything that you shouldn't be doing. Administration. With 401ks, because you have all this power, like the checkbook writing, you don't have a custodian, you don't have a company looking over your shoulder, right? So you do all the administration, the bookkeeping, record keeping, all right? IRS reporting. And an audit trigger. IRS is always looking for ways to tax you. So, I mean, when you have these powerful accounts, they may, if they have a stack of piles and they have Roth IRAs here, traditional IRAs here, and solo 401ks over here, they're probably looking for this one a lot more than these two. Right? Or even ESAs, right? Don't look at those at all, right? But point is, it just puts more eyes on you, but it's not a big deal. If you can have this account, it's definitely something to consider. The vesting, like I mentioned in the IRA account, the vesting of the IRAs with Quest Trust Company, FBO, right? For the benefit of, it's a little different in the 401k. So this is just for anybody who has a 401k or anything like that, just extra information. Cool. I want to get to the case studies. It's a lot of time on the accounts. But the case studies, I have 2 of them. One of them is so you guys can see how multiple accounts are used. And also I like to show, because I'm 25 years old and I was able to do an investment. So I think anyone could do an investment in an IRA, right? I did it with $6,000. I'm gonna show you how. So I did a first lien promissory note, right? So I always wanted to get involved. I wanted to practice what I was preaching at work. And one day I got called and a friend of mine, she's an investor. She had promissory note opportunity. And she was like, I know you wanted to get involved. We're putting together a bunch of different IRA accounts and we need some money. How much do you have in your retirement account? At this moment, I had none. I was like, oh man, I should have contributed. So what I did is I opened a Roth IRA as soon as possible and I contributed the maximum, $6,000. And I was like, okay, I have $6,000 in my Roth IRA. She's like, cool. Well, we're going to put you in this promissory note if you're game, right? And what the promissory note is $157,000 funded by 9 IRAs. All right, I'm going to show you an example of what this looks like. So this may be small. I had to redact things. I don't know if people are iffy about their information, but it's really just names and account numbers. But basically, this big paragraph, the biggest thing I want to get by is that big paragraph is just 9 different IRA names because they're so long, right? Just 9 different IRAs. And it shows their percentage. So for example, the first one that put up 79,000 of the 157 had 50.32% interest of this entire note. The smallest one, which was an ESA, the education account for a child, had $3,000, which had 1.9% of the deal, which means that when the borrower makes a payment of $1,000, right, 50% of that is basically going to one of the people, and 1.9% of that is going to that small ESA, right? It's being split. That's a way to get everyone involved, and everyone's kind of making pretty good interest rate on their money. I was kind of in between here with just $6,000. There's a few Roth IRAs, there's an HSA, there's an ESA, there's a lot of accounts here. But the cool thing was that this was something they were giving us a first lien position. Also, the borrower we knew, so someone I trusted as well. I knew him personally through networking events. And they're like, hey, the person that called me, she's loaned to him before. So she knows that he's a good borrower, right? So those borrowers out there understand that if you make your private lenders happy, they will come back. So she knew him. She was like, hey, this is a good deal. They're going to give us a first lien position on this property. The property is worth already what they're loaning us. They just need to they're getting it at a real good price and they do some repairs on it. So we're like, it's kind of a no-brainer. We did a 1-year maturity, but we knew he was going to pay us off before. We had 12% interest. So the profit in total was about $18,840, just under $19,000. My Roth IRA got, I believe it was, 3.83% of that, right? But I got that in 6 months. Right, so I did very well for just 6 months of my Roth IRA being out in some investment, right? Which, if you left that in your bank, $6,000 probably would have got you a few cents, right? My Bank of America savings account makes like 0.001% interest. Capital One makes like 0.6, right? So it's not too much. You're making a lot more doing these kinds of deals. So the kind of idea behind this is basically you can leverage your accounts. This could have been a whole family. This could have been 9 family members because they're all just one side of the fence, right? This could be you and your network. right? This is kind of how these deals are structured. This is kind of these passive investments, Mercedes, that you were asking about. What do people see? People do is one of them, right? Passive investments. So that was, one of mine. I wanted to share that. It was pretty cool and pretty simple, honestly. It was 6 months. I didn't have to do anything. I slept good at night. It's pretty easy. The steps were, I opened my account, I contributed, I put money in the account. I did it contributions, but it could have been transfer rollovers. Then what I did is I got with my notes team, my notes department. Their goal was to review these documents to make sure that everything was looking right, make sure the lender was written correctly, make sure each individual account holder was all good with the note that they provided, and then also funded it. The borrower made payments directly to Quest, not in separate payments, one whole payment, and we split it. Right, so as the account holder, you're kind of just sitting back, letting your money coming in. Now this next one is a little bit more hands-on. Oh, actually, I have some keynotes here. Sorry. We negotiated terms, right? So you negotiate everything. The Quest doesn't do anything. Quest doesn't have any deals for you guys. It's all you guys finding these deals through the networking opportunities. All lenders, I mentioned that we put some documents in. Borrower made one payment, talked on that. We closed our title company. We used lender's attorney. So we kind of used our legal team that we wanted to use outside of Quest. You choose the note maturity date, you choose the interest payments. And the biggest thing is that we use tax-free accounts, right? Mercedes, I know you're a fan of the Roth IRA. We use Roth IRAs, we use ESAs, right? All of the money that was made in that deal is tax-free. Now this is a different scenario, more of buying property and how you can actually take title to property, right? So this is an individual who rolled over a former employer plan, a 401k. So they had all their money in their 401k account. This is usually what happens with Americans' wealth. They rolled the money over to a traditional IRA because their 401k was pre-tax dollars. So they didn't want to be taxed at the moment. They don't want to put it in a Roth yet because they'll be taxed. So they just moved it to a traditional, kept it in the same bucket of money. They're not pay taxes on that. They found this opportunity to buy this property for $330,000. This was in a pretty good area in Houston, but it was way back when. So it was a good price. The offer was made and the title was drawn up. And again, this is the vesting. This is the name of the IRA account, the actual thing that's going to take title and be on the deed. So the property is owned by the IRA. So all the rents are collected and deposited to that IRA account, right? Not to you personally, right? Another thing to mention is all expenses are paid with this IRA account. So anytime there's like a plumber you got to pay or whatever it may be, that's also gets paid out of the IRA. This guy was getting about $5,000 a month, right? 10-unit property, so he's getting good return here. 19% annual return on money invested. And he's also just getting the appreciation in the cash flow, right? So not just the cash flow, but the appreciation of the property, right? That's something to think about because as the property grows, eventually when you sell, that's when you're making big bucks, right? All this was completely tax deferred. Now this property was in a great area in Houston, I think it was in the Heights, right? So what happened was this $330,000 property eventually became close to $1 million in about 10 years or so.
Nice.
Right. However, this individual didn't do a Roth conversion, right? Because what he saw at the time that he did his investment was $300,000. I'm not paying taxes on that. No, that's gonna be a huge tax bill. So he left it there. That's okay. That's what most people do. But what if he would have done a conversion then? Really bite the bullet. Now, if he was able to, right? Maybe half of it and the half later, whatever it may be. But what happened is that appreciation of his property would have grown tax-free. And eventually, even though he bit a huge bullet, $330K is not little, then he would have had, close to $1 million Roth IRA, right? So that's always something to consider. If it's a good opportunity to do conversion, consider it because you're going to bite yourself in the butt if that deal is amazing and you wish you had done it tax-free, all right?
Hey,
So
on that deal.
Yeah, sorry, go ahead.
Sorry, Slade. On that deal, so John Smith, he could be a disqualified person if he was engaged in the activity of managing the property, right? He's got to be completely removed.
Yeah, so good question. So when these investments, you definitely want to remove yourself, right? So although it's a rental property, ideal situation, you have a rental, especially for a 10-unit property, you have some kind of property management company. Yeah, right. You kind of want to pay.
I think anything over 4 units, I think you have to have a property manager, right?
So I don't know if it's like anything over 4 units or anything. I mean, you can find I don't know about that, but I just know that, especially for something with a lot of units, you kind of want to. I don't know. if you have to after a certain amount. But even with one unit, you know, if you know it's just one pair of tenants, then you may want to get a property manager. However, you don't have to. You're not forced to. But as long as you understand that those tenants need to make payments directly to the IRA account, and the IRA pays expenses, not you, right? That's where you get in trouble. Yeah. Now, real life situation when things happen with, especially with real estate, is if Saturday you need to go in there and fix a light bulb or do something, right? We're not expecting you to let all hell break loose because it's a weekend and Quest is closed and we have the money for your IRA account, right? So in real life situations, there's ways around these rules. But what happens is if you have to go in there and make a repair, and let's say the contractor's charging $1,000 for the repair that you had to do on a Saturday, but it was an emergency, obviously you had to get that paid. I would recommend, don't tell us how that was paid. Just make a contractor happy, get them paid, call Quest and be like, hey, you can do a few things. You can be, hey, my tenants, maybe have the tenants pay for it and have the tenants get reimbursed by your IRA the next following business day. Or have what we call our Bob solution. Have someone in place that you can go to, which is a non-disqualified person. Let's say like your brother, right? Your brother may or may not have paid the contractor. Maybe your brother, who knows? Your brother's not disqualified to you. You can say, hey, custodian, my brother paid $1,000 expense this weekend for my property. I need to reimburse them. We would easily be able to write that check because we're writing that check to someone that's not you. Now, do I know if your brother's like your neighbor, your brother just Venmo'd you the money? I don't know, right? We don't know that. So we call it the Bob method because the IRS is not in the bushes watching you, and there's real life situations that you got to take care of. So sometimes that's your property manager. Sometimes you don't need a property manager. There's just ways around those rules that you want to be prepared for. And that's why we don't see many people investing into these active investments where you have to be on top of those kinds of things because it comes with a kind of headache, right? But with passive investments like syndications, you don't have to worry about that because you're just moving money. Someone else is using your money to do the project. You're kind of hands free, which is why that's more popular than these kinds of investments. Sorry, go ahead.
Exactly. So me as an active syndicator, I should not use my own IRA for my own deal. It would be other folks investing in it, right?
Yeah, exactly. So even though Mike knows this is going to be a fantastic deal, he has to exclude his IRA account. Right?
I got to find another deal. That's what I got to do.
Find another deal. He can't even put his wife's IRA in the deal. Your parents can't be involved in the deal, and your children can't be involved in the deal, right? So unfortunately, but you need to find another deal.
Perfect.
Now this is almost my last slide here, and the waste of profit now is really OPI, and it's not nail polish. It's other people's IRAs. Right? Other people's IRAs is if you're an individual who, kind of the way Mike's using it, right? If you're an individual who's looking for capital, don't have your IRA account, but you're an investor, you're trying to put food on your table, you're trying to make deals happen, look at financing from IRA accounts. Don't just look at banks, hard money lenders. So now that you know that this is a possibility for IRA investors to do, you can take this knowledge, tell other people about it, right? If you're a realtor, you can basically broaden your client list because now you can say, hey, my client doesn't have enough money to buy a property themselves cash, but maybe they have a lot of money in their retirement account, right? So you can use retirement accounts. You understand that this can be possible now. This is another way to leverage that. People within your own network, people within your family, right? If you know your brother was making good money, but they just happened to lose their job, you might want to go up to them and say, hey, what are you doing with that 401k, right? You could actually potentially loan me that money. I don't know if you want to have your brother loan you money because if you foreclose on them, the following Thanksgiving is going to be weird. But the point is that you could potentially use your network's money, right? So just think about that. That's ways you can profit today by using other people's IRAs. Always, so this is kind of the end of it. You can always call us, right? Client or not client. We have expertise on IRA accounts in general. So just give us a call if you have any questions in regards to it. That's the email for like our department of the IRA specialists. That's my email. So feel free to contact me whenever you guys need. I'm here to help. Again, you don't have to be a client for it. So happy to help any way I can. If there's more questions, guys, I'm happy to answer them tonight. So.
Thank you, Juan. That was very good.
Nice job, Juan. By the way, guys, so I reached out to Juan, but I'm also a client of Quest, and that was my experience with them. And Juan isn't going to send me $20 or anything, but I will plug the company. I invested passively about a year ago into a couple of deals, and it was the same situation. I didn't necessarily have the liquid cash to be able to invest, but I was on a webinar and it was run by Quest on another syndication. So there was another syndicator that was looking at a multifamily deal, and they brought Haley on. And so I listened to it and I'm like, I can use this. It was an epiphany for me. I had no idea you could even do this. And so I took my traditional IRA and I invested into a couple of deals. And so I don't touch the money. It goes completely there. And the process is pretty smooth. The beauty, the other thought part I really like is, besides my own vetting, so you got to do your own due diligence on the person you're going to give your money to, right? Whether it's your money or your IRA's money, it's still your money. But Quest does a really good job of, they go through all the paperwork as well. So if you haven't done a syndication, there's a PPM, right? A memorandum. So it's an offering memorandum. That has to get pretty well scrutinized by you. It's usually 30, 40 pages, but Quest does it too because they want to make sure it's legit, right? They want to make sure that it's not some, Bernie Madoff account that this money is just going to go to. So they do some qualifying to make sure that your money is protected through some of that due diligence, which again helps. It's an addition to what you're doing. Now, obviously, they don't guarantee returns or anything like that, but it does vet that it's a viable account to go into. So I had a great experience, and so I wanted to share that with the group. And if you guys have any questions, obviously Juan's info is there. And if you have any questions for me, please reach out.
Yeah, exactly. Yeah, very simple to do. Don't hesitate to ask questions. I'm not saying you have to go with Quest or anything like that. It's just